34 quality dividend stocks are on my watch list, and I'm going to share them with you, you lucky dividend investing viewers. So sit tight, relax, and tell us in the description below which stocks are on your watch list. What's up? I am Russ, a welder that is passionate about passive income. So remember, this is not financial advice, just some things on my watch list, sharing with you. Put them on yours, do some digging, see if they might be right for you. And don't forget to go to DapperDividends.com and sign up for my free and fantabulous weekly newsletter, where I share an investing thought, the portfolio activity, dividends received, and some stocks about to go ex-dividend. And as always, if you'd like to save a bunch of money on a Seeking Alpha annual subscription, there is an affiliate link below. I also share this watch list and the portfolio, all the activity. You can follow me on Blossom Social Investing. There's a link below. Hey, everything is below. Just go below and head on over there and you can follow me, Dapper Dividends. Say hello. Pause the video if you want to look at anything more in depth. We're going to move through this really quickly and then show you a couple that really caught my attention that look really, really solid. And here's some watch list fun facts. The average company founding was in 1950. The average dividend yield is 1.05%, and the average 5-year return on capital employed is 31.59%. And remember, a 5-year average ROCE over 20% shows a company makes money very efficiently, likely indicating it has a durable competitive advantage. And do remember that you can get a free 2-week free trial on SimpliSafe. Just give them your email address. That's it. So we sorted this by the most overvalued, and we'll get to the least. First is Armanino Foods, ticker AMNF. They sell Italian specialty foods like frozen pesto and pasta sauces. And despite them being a small microcap company, they've paid increasing dividends for over 20 consecutive years. I'm sure everybody's aware of Costco, ticker COST. They make their money through membership fees and sell in that bulk merchandise at thin margins, and their $1.50 hot dog and soda combo hasn't changed since the early 80s. One more thing about Costco, I love the story when former CEO Craig Jelinek brought up the idea to founder Jim Senegal about raising the price of the hot dog soda combo, and Jim Senegal said, "If you raise the effing hot dog, I will kill you. Figure it out." And it's still $1.50. Next, we got Republic Services, ticker RSG. They collect your garbage and recycle across the U.S., and they operate the nation's largest fleet of natural gas-powered vehicles in the waste industry. Love TJX Companies, ticker TJX, TJ Maxx Home Goods. They sell brand name clothing and home goods at discounted prices, and they source their products from over 21,000 vendors globally. Cintas, ticker CTAS. They rent and service uniforms, entrance mats, safety products to businesses, and they started as a rag cleaning company during the Great Depression. WW Grainger, ticker GWW. They make money by distributing maintenance, repair, and operating supplies to businesses. It's a company I use in my line of work, and they maintain over 1.5 million products in their inventory. Williams Sonoma, ticker WSM. They sell high-end home furnishings and kitchen products through stores and online. Fun little fact, their Pottery Barn brand was featured prominently in the TV show Friends. Now we get to the reasonably valued companies, and one that is at the tippy top of my buy list is Rollins, ticker ROL, which they do pest control. They are the Orkin people. Snap-on is next, ticker SNA. They sell premium tools and equipment to professionals and mechanics. They franchise out those mobile tool trucks you see driving around, and they're so respected that their tools are even passed down through generations of mechanics. Pulte Group, ticker PHM. They build and sell those single-family homes across the United States, and they're one of America's largest home builders, which was founded over 70 years ago. MasterCard, along with Visa, we do own Visa. They make their money by processing credit card payments and collecting the fees on the transactions. A lot of people get this wrong, and it's a misconception about Visa and MasterCard, as they are not a financial institution. All that they do is process the payments. That is it. They collect a small fee from those. And then we got Tractor Supply, ticker TSCO. They sell those farm supplies, pet food, and ranch equipment to rural homeowners, and they found a profitable niche serving the rural lifestyle that Amazon struggles to reach. Paychex, ticker PAYX. They provide payroll processing and HR services to small and medium businesses like the one I work at, and they handle payroll for approximately 1 in 12 private sector workers in the United States. Mueller Industries, ticker MLI, manufactures copper, brass, and aluminum products for plumbing and HVAC industries, and their products are essential components in buildings all around the world. Amphenol, ticker APH, manufactures electrical and fiber optic connectors, which are used in virtually every electronic device from smartphones to satellites. Badger Meter, ticker BMI, they sell water metering and flow measurement systems, and they help water utilities reduce waste with their smart metering tech. I think everybody knows what Domino's Pizza does, ticker DPZ, with their pizza sales, but also that they're franchisor of their pizza restaurants globally, and they revolutionized pizza delivery with their online ordering system. Pool Corp, ticker POOL, distributes swimming pool supplies and equipment to contractors, and they are the world's largest wholesale distributor of swimming pool products. I like metal detecting, and Ross Stores is in that vein with their treasure hunt shopping experience. So Ross Stores, ticker ROST, sells discounted brand name clothing and home goods. Old Dominion Freight Line, ticker ODFL, is in my wheelhouse of my industry. They provide less than truckload, which is LTL, shipping services across North America, and they have one of the lowest claims ratios in the trucking industry. All right, it's time for some undervalued companies. We got S&P Global, ticker SPGI, which they make their money through financial information services, ratings, and market indices. And you're probably familiar with their S&P 500 index, which is the most widely followed equity benchmark in the world. FactSet, ticker FDS, provides financial data and software to investment professionals, and asset managers controlling over $180 trillion rely on their data. Graco, ticker GGG, manufactures fluid handling systems and equipment, and their pumps handle everything from car paint to ice cream toppings. A.O. Smith, ticker AOS, is a manufacturer of water heaters and water treatment products, and they are the largest manufacturer of water heaters in North America. Next, we got ticker MSCI, which is Morgan Stanley Capital International, and they create investment indices and provide portfolio analysis tools, and over $17 trillion in assets are benchmarked to their indices. Google, ticker GOOGL, obviously you know what they do. I think YouTube is the most interesting part of their business. Maybe they should spin that off someday. But either way, they still process over 8.5 billion searches a day. Next, we got one my guy Ryan Williams just bought, which is Zoetis, ticker ZTS. They develop and sell medicines and vaccines for your pets and livestock, and they're the largest animal health company spun off from Pfizer. Toro Company, ticker TTC, they manufacture outdoor maintenance equipment like lawnmowers and snow blowers, and they're famous for maintaining many famous golf courses and sports fields, Wrigley Field, worldwide. Landstar System, ticker LSTR, they coordinate freight transportation through a network of independent truck owner-operators, and they don't own the trucks, they operate through 10,000 plus independent contractors. Now, these last few were not valued by Simply Safe, but I still think they are really interesting companies. You got Build-A-Bear Workshop, ticker BBW. They sell their stuffed animals through the retail stores and e-commerce, and they have actually diversified beyond children to adult collectors with pop culture collabs that drive 40% of their sales. I work with this company every week, which is MCore Group, ticker EME. They provide mechanical and electrical construction services for facilities and infrastructure, and they're one of the few construction companies that maintain profitability during every year of the 2008 to 2010 recession. You might not think it, but this is a company that's gone way up since I put them on the watch list. Nathan's Famous, ticker NATH. They make money through hot dog licensing, they franchise their restaurants, and that famous annual hot dog eating contest over Independence Day here in the United States States, began in the early 1970s, but they actually marketed it with a mythical 1916 origin story to generate publicity. Simpson Manufacturing, ticker SSD, they got construction products like wood connectors, fasteners, concrete anchoring systems. If you've done any kind of decking, you might have used one of their Simpson strong tie screws. They've been in the business since 1956, and they're crucial suppliers for earthquake-resistant building tech. And then we'll wrap it all up with Wingstop, ticker WING. Just like Domino's, they franchise their restaurants across the US and internationally. And check it out, they've had 19 consecutive years of same-store sales growth, which is a remarkable achievement in the restaurant industry. One of the ones I wanted to highlight is Cintas, ticker CTAS. Now they are overvalued, but this is one that is almost a no-brainer buy if it ever gets into that buy zone of $156 to $191. Now in 2021, they switched from an annual to a quarterly dividend, but just very fast dividend growth of 42 years. And yes, they are a little bit overvalued right now, but just a very strong company, and I'll show you why. But we'd like to see that dividend yield come up above the 5-year average, hopefully, and that forward PE come a little bit down to the mid-30s. Their earnings and free cash flow payout ratios, you like that when it stays flat because it means they're growing the dividend and it's not coming out of any more earnings or free cash flow. So this is just the stuff you want to look for in a great company. The stair stepping up almost every single year with earnings per share, free cash flow per share. They have positive sales growth almost every single year. They've mostly continued to buy back stock, and their total sales just keep going up and to the right. And not only that, but their margins keep expanding. Their return on invested capital, almost 24%, free cash flow margin of 18%. Now their net debt to capital is 35%. That means that in their capital structure, 65% is equity. And their interest coverage ratio is 22.8. If you don't know what that means and you're new around here, interest coverage ratio tells us how many dollars of operating income or EBIT do they have to cover every $1 of interest on the debt. So currently, Cintas has $22.80 of operating income to cover easily every $1 of interest on the debt. FactSet doesn't get a lot of love around the community here, so we'll give it some. But dividend safety score of 95, very safe. They do that financial exchange and data. They do look to be undervalued. 25 years of dividend growth. They grow that dividend pretty fast. Their PE is below the 5-year average. We like to see that. And here we go again. Just the flat earnings and free cash flow payout ratio means that they are making lots and lots of money and not having to pay more and more of the increasing dividend out of diminishing or stable free cash flow. So just wonderful to see that. And that tells the tale right down there. The earnings per share and free cash flow per share keep going up and to the right. Positive sales growth every year. They've kind of hit the pause on buying back shares, but no worry, their total sales keep going up and to the right. Now, unlike Cintas, their margins are still high, but they've remained flat or somewhat compressing, but still really outstanding. And their net debt to capital, 40%, and an interest coverage ratio of $11.70. And then Zoetis, ticker ZTS, I'd look at them as pharmaceuticals for your pets, but a dividend safety score of 74, and they look to be way undervalued. So they're growing that dividend very fast. They have an uninterrupted and a dividend growth streak of 11 years. The dividend yield is way above the 5-year average. The forward PE is way below that 5-year average. Their free cash flow payout ratio is still only 34%. That's really low. But their financials just all around look really solid, with their free cash flow per share continues to keep going up and to the right. I mean, honestly, we treat our pets like members of the family, right? So it's not hard to understand why. Sales growth is positive every year going back to 2016. They continue to buy back shares. Their sales keep going up and to the right. Their margins are actually slowly expanding. And 25 cents of every dollar of revenue coming in makes its way down to free cash flow, which obviously free cash flow, you can pay the dividend, you can buy back shares, you can carry it as cash on the balance sheet, you can do mergers, acquisitions, things like that. So free cash flow is the lifeblood of the business. And their net debt has been coming down, only 51%, but even more wonderfully is the interest coverage ratio has actually been growing. Currently $15.10 of EBIT, earnings before interest and taxes, to easily cover every $1 of interest on the debt. I was going to tell you about Google, but all you need to know, they have a super solid balance sheet, very well run company. They were dominant, and I say were because you got to wonder if they're going to figure out this search thing where market share is kind of being taken by a lot of the generative AI, right? So that's to be watched. YouTube, fantastic business, but hey, if we hit a steep recession, advertising is usually one of the first things to get cut from a company, you know? So anyway, in this floating little box next to my head, speaking of a company that makes money on advertising, my number one position has a 24% yield. Might not be exactly what you're thinking, but you'll still learn something. So if you haven't seen it already, click that video and I'll tell you all about that there.